April 2020. I filed my tax return, paid every dollar I owed, and found a second bill sitting underneath it. A penalty for doing nothing wrong. I'd filed on time, I'd paid everything, and I still owed extra. That's the IRS underpayment penalty, and it hits almost every man in his first year of retirement because nobody tells them the rules change the day they stopped working. For 40 years, my employer handled the taxes. Every paycheck, a portion went straight to the IRS without me doing a thing. Then I retired in June 2019. IRA withdrawals, consulting income, part-time teaching. And all of it landed in my account with every dollar intact. The IRS was still expecting quarterly payments throughout 2019. I just didn't know that was now my job. April 2020, the penalty was sitting there on the return. Over $1,000 for a rule I'd never heard of. So today I'm covering the 4 things that prevent this, including one move you can make in December that clears an entire year of missed payments in a single afternoon. Most men have never heard it exists. By the way, my name is Edward Gray and I'm a retiree just like you. On this channel, I share what I've learned from my own retirement, my own mistakes, and the conversations I've had along the way, so you can see where you stand and what you might do differently. If that sounds like something you want more of, hit subscribe and become part of this community. And while you're down there, drop a comment. Did you get hit with an underpayment penalty in your first year of retirement? Tell me what happened. All right. 2 things about how this penalty works that most men don't know until they've already been hit. The IRS expects 4 payments per year: April 15th, June 15th, September 15th, January 15th. That's the quarterly schedule you're now responsible for once W-2 withholding stops. And the one that surprises people most: you can pay everything in April when you file and still owe the penalty. Because the penalty isn't about whether you paid, it's about when. The IRS wanted money in April, June, September, and January. If it all arrived the following April, the earlier quarters were still short, and the penalty runs on every one of them separately. For a man with $80,000 or more in retirement income and nothing withheld all year, the combined federal and state penalty easily hits $1,200. And here are the 4 things that prevent it. Okay, the first one is the safe harbor rule. And it's the most useful thing most new retirees have never heard of. You avoid the penalty completely if you pay 100% of last year's total federal tax across the 4 quarterly deadlines. That's all. Pull out your most recent Form 104. Oh, find line 24. That's your total tax for last year. Divide that number by 4. Pay that amount each quarter, covered, even if this year your income jumps, even if you owe more in April. The penalty doesn't apply because you hit the safe harbor. If your income in the prior year was over $150,000, multiply by 110% first before dividing. So $12,000 becomes $13,200, paid at $3,300 per quarter. Copy last year, divide by 4, pay on time. That's the whole thing. Now, there's one thing about Q2 that catches men who think 4 equal payments spread evenly across the year will keep them clean. Q1 covers 3 months. Q2 covers 2 months, April and May only. Q3 covers 3 months, Q4 covers 4. Q2 arrives faster than men expect because it only covers 2 months of income, and if you're treating it as a normal quarter, the June 15th deadline catches you short. Write down the 4 dates the day you retire: April 15th, June 15th, September 15th, January 15th. Calendar them. And the second fix is even simpler, because it takes the deadlines completely off your plate. You can ask the people paying you to withhold taxes directly, the same way your employer used to. For IRA distributions, there's a form called a W-4R. You file it with your IRA custodian, Fidelity, Schwab, Vanguard, whoever holds your account. You tell them what percentage to withhold from every distribution. They send that amount to the IRS automatically, just like your old employer did. For pension income, the form is called a W-4P. Same idea. Tell the pension administrator to withhold a percentage, and it happens automatically every month. For Social Security, you can request withholding at 7, 10, 12, or 22% using a voluntary withholding request form, Form W-4V, filed with SSA. When you do this, the withholding is treated exactly like W-2 withholding. It counts against your annual tax liability. It protects you from the underpayment penalty, and you never have to think about quarterly deadlines. For men who don't want to think about quarterly payments, who spent 40 years never worrying about this because it was automatic, the W-4R and W-4P recreate that same automatic system for retirement income. You said it once, it runs all year. April arrives and the penalty isn't there because the tax was paid throughout the year without you having to manage a thing. And honestly, if you're hearing about the safe harbor or the W-4R for the first time right now, that's the norm for new retirees. Almost every man who came off a W-2 got hit in year one. The automatic system just stopped, and nobody said a word about what to do next. Now, if the first two fixes gave you something to act on, and I hope they did, hit the like button right now. Not as a favor to me, because there are men watching this who are 1/4 away from the penalty arriving and don't know it yet. YouTube uses the like signal to put this in front of them. If this helped you, passing it on takes 1 second. And if you're not subscribed, every week this channel covers the things that cost new retirees real money, simply because nobody told them the rules changed. If you watch one more and leave, that's fine, but you'll miss the next one. Subscribe now, and you won't. All right, the third fix is the one most people have never connected to this problem. And for men who realize in November they've made no payments all year, this is the one that saves them. The IRS treats withholding differently from estimated quarterly payments. A quarterly payment you make in December gets credit for December only. If you owed payments in April, June, and September and didn't make them, a December payment doesn't fix those earlier quarters. The penalties for each missed quarter already exist. Withholding works differently. When taxes are withheld from any income, including an IRA distribution, the IRS automatically treats that withholding as if it was paid equally across all 4 quarterly due dates throughout the year. So if you have $8,000 withheld from an IRA distribution in December, the IRS treats it as $2,000 paid on April 15th, $2,000 on June 15th, $2,000 on September 15th, and $2,000 on January 15th, even though you withheld it all in December. This means a man who realizes in late November that he's made no quarterly payments can take an IRA distribution, elect withholding at whatever percentage covers his annual tax liability, and have that withholding count as if he'd been paying all year. The earlier quarters are covered retroactively. Now, you have to do this before December 31st for it to apply to that tax year. And if you want the full converted amount to end up in a Roth, rather than going partially to the IRS, you do the 60-day replacement from outside money that I covered in the Roth conversion scripts. But even without the Roth piece, just the withholding from an IRA distribution in November or December can clear the underpayment penalty for the whole year in one move. And there's one more thing I want to mention specifically for men in their first year of retirement right now. The IRS has a first-year retirement exception. If you retired after turning 62 in 2025 or 2026, and the underpayment happened because you retired, not because of willful neglect, the IRS can waive the underpayment penalty under IRC Section 6654. You have to request it. It doesn't happen automatically. When you file your return, you attach a statement explaining that you retired during the year, the underpayment resulted from that retirement, and you're requesting a waiver under the retirement exception. Your tax preparer can handle this. Or if you're filing yourself, the request goes with the return. Most men who qualified for this waiver in their first year of retirement never filed for it. They didn't know it existed. They just paid the penalty and moved on. If that's you, and if you retired in 2025 and got hit with the penalty on your 2025 return, it may not be too late to amend and request the waiver. Talk to a tax advisor about whether the window is still open for your situation. All right, let me land this. You retired. The automatic withholding that ran for 40 years stopped the same day. IRA, income, pension income, consulting fees, investment income, all of it now arrives in your account without the IRS getting its share automatically. And 4 quarterly deadlines are waiting for you whether you knew about them or not. The safe harbor gets you protected immediately. Copy last year's total tax from line 24, divide by 4, pay that each quarter. The W4R and W4P forms set withholding directly on your IRA, pension, and Social Security. So the whole thing runs automatically and you never think about it. The December withholding move covers the whole year in one late year distribution if you've done nothing and November arrives. And the first year retirement exception exists specifically for men who got hit in their first year of retirement without knowing the rules changed. Ask for the waiver when you file. Any one of these prevents the $1,200 surprise. All 4 together mean it never happens again. Drop a comment and tell me, did you know any of these 4 options existed before today? And if you're currently in your first year of retirement and haven't set up any withholding, this week is the week to do it. Q3 is still in front of you. Getting withholding set up now reduces the damage, even if Q1 and Q2 already passed. And if today gave you something useful, share this with someone who retired recently and hasn't been told any of this. Because the surprise in April is entirely avoidable. They just need to know the rules changed. And if you're not already part of this community, come join us. Because this is what we do here. Real retirement, real money, from guys who are actually living it. Hit the subscribe button and ring the notification bell. See you in the next one.